Hello, everyone. Welcome to the series Mud Talks Navigating the Waves, San Diego Housing Market and NAR Rules Impact on Buyers and Sellers with Karim Abdulla, Class of 96. My name is Vanessa Chu, Associate Director in the Office of Alumni and Parent Relations. We thank you for attending today's event. This talk is being recorded and will be distributed after the event. Please feel free to type your questions in the Q&A box and we will try to get through as many as possible. Now, I'm going to turn it over to our speaker. Karim, thanks for being here today. The floor is all yours.
Awesome. Thank you so much for having me, Vanessa. Good evening, everyone, and welcome to our talk tonight. Thank you guys for taking time out of your busy schedules and joining us here. My name is Karim, and I'm super excited to be able to talk to you today about the San Diego housing market, what it's been doing, what we think is going to be happening in the future in 2025, and also super excited that this is our first Mud Talk session of the academic year. With that, let's get started. Let me share my screen. All right, let's see here. You should be able to view it. Okay, very good. Let's jump on in. As far as agenda is concerned, let's see here. Try to navigate. There we go. Okay. So as far as agenda is concerned, I thought what we do is just go over three things, really. First, we'll just start off with just a short introduction of who I am, and then we'll dive right on in and start discussing the details of the San Diego housing market. We'll talk specifically about the current trends that we're currently seeing in the marketplace today. We'll talk about the drivers that are affecting the market and what we think will continue to affect the market in the future. And we'll also look at, of course, the 2025 outlook. In the latter half of the presentation, we will shift gears a little bit and focus the talk around what's been happening with the National Association of Realtors, the litigation, and then the subsequent settlements. We'll talk a little bit about what it's all about and why we think it's a pretty big deal and maybe that it'll have effects on buyers and sellers in the future as far as how real estate is transacted going forward. So we'll dive right into all of that. Okay, so for those of you that don't know me, my name is Karim Abdulla. I've lived in Southern California really my entire life. I grew up in Los Angeles and moved to San Diego right after graduating from Harvey Mudd back in 1996 and with a degree in EE. I then pursued my master's in digital signal processing at UCSD and graduated in 2001. And over that time since then, I've worked at a variety of wireless semiconductor companies here in the San Diego area. My passion for real estate is really what led me to obtain my real estate license in 2008, after which I started the Karim Home Team with Home Smart Realty. And over that time, I've represented countless buyers and sellers transacting, several hundred million in volume. I'm the author of a monthly blog. We call it Real Estate Dollars and Cents. And I published my first book, Selling Your Home for Top Dollar, in March of 22, which you can see there on the right. And actually, in the 11th hour last night, my daughter reminded me that I had forgotten to include my QR code on this slide. So if it looks like we cut and paste the QR code in the 11th hour, it's because we cut and paste the QR code in the 11th hour. Okay, so you can actually just use that QR code to access the book. It's a free ebook. You can gain access to that. It'll also allow you to enter in your contact information so that you would be able to subscribe to our monthly blog of Real Estate Dollars and Cents. And of course, for those of you that would prefer a physical book, just reach out to me after the presentation and we can absolutely arrange that as well. Okay, let's talk about this housing market. So as of October of this year, what we've seen in the United States at large is that new home sales have risen by 4.1% month over month and about 6.3% year over year. So the annual rate of homes sold is just over 738,000, and that's according to the U.S. Census Bureau. What's interesting is that This marks the highest level of new home sales since May of 2023. Now, nationally, if you look at the median new home sales price over the last 1 year or so, it's basically unchanged. We haven't seen a lot of movement there. And that price point right now sits at about 426,000, just over that. Of course, we also know that San Diego is a very, very different market from what we see nationally. If we look at the median sales price in San Diego, we're up about 7.5% year over year, and we're selling at a median price of just under 900,000, which is quite staggering when you think about that. So at the bottom, I included some key metrics that I thought was interesting to just see and take a snapshot of. On the left there, we'll see that the segment that experienced the highest year-over-year growth was the single-family residence segment, and that growth rate was about 10.6%. That segment is in contrast to, say, the condo segment, townhomes, multifamily, etc. So single-family detached homes has experienced the highest growth at 10.6%. Now, if we look at days on market, this is a metric that we use to determine how quickly homes are selling. So from the time a home first hits the market to the time that it ultimately goes pending with a ratified contract, that's measured as days on market. And the price point between 750,000 and 1 million in San Diego has experienced the quickest or the shortest market time, rather, at just 28 days on market. And then finally, another key metric that we look at is the amount of inventory that we have, the number of months supply of inventory that we currently have. So right now in San Diego, we're currently sitting at about 2.3 months of inventory. And this is actually a rise of just under 31% year over year, which is great news, of course. We'll talk more about inventory as the presentation continues, but generally speaking, a rise of 31% when we've been really limited by supply is definitely great news. The one note I wanted to mention here is the way we calculate this metric actually is we just take the number of active homes that are on the market at the end of a given month, and we divide that by the monthly sales rate of homes over the preceding 12 months. So pretty straightforward calculation, certainly from others. But yeah, so we're up about 30% year over year on this. Okay, on this chart here, this is home sales volume trends, and what I try to do with this chart is plot out the number of homes sold over the last 10 years, and then overlay on top of that the average 30-year mortgage rate. Okay, now I specifically zoomed in on 4-bedroom detached homes, and the reason why I did that is because if you aggregate all product types together, it's very difficult. And by product type, I mean 3 bedrooms, 4 bedrooms, 5 bedrooms, etc. It's very difficult to discern product mix changes over time, right? So for that reason, I like to zoom in on a specific product type, in this case, a 4-bedroom detached home. And actually, that's a really common product type for clients of mine. So we just zoom in on that and kind of see what that's been doing over time. When we look at this chart, we see some, at least a couple of very interesting things, in my opinion, anyway. So the first thing we see is that the rise of interest rates between 2021 and 2023 basically reduced the number of homes sold from 9,000 all the way down to just under 5,000. So that's like a 55% peak to trough there. So the number of homes really came down by quite a bit, by 55% in this case. The other thing that I thought was interesting was that the effect of a 5% interest rate had very different impacts in time. So for example, if you look at a 5% rate in 2018, or just under 5%, and then you look at a 5% interest rate near 2022, it has very different effects on the number of homes sold, even though the interest rate's effectively the same. And so you can see here in 2018, we had still had pretty healthy home sales of about 8,000, whereas, by the time we got to 2022, we're down to about 6,500. And why is that? Well, to answer that question, I think it's helpful to look at what interest rates did, immediately prior, the couple of years prior to that 5%. And so if you look at between 2016 and 2018, we went from just under 4% to just under 5%. So we didn't have dramatic movements in interest rates, and the growth was, relatively slow, right? Now, if we look at 2021 to 2022 and subsequently in 23, we see that we started out at like a 3% rate, which is, an all-time low, at least very near an all-time low of what rates dropped down to. And so when we look at that, a couple of things happen. When rates are that low, it stimulates a lot of demand. When there's a lot of demand, you have a lot of transactions. And when there's a lot of transactions, you have a lot of number of homes selling. But now the other piece of this puzzle is that when rates are down at this 3% rate, you tend to have a lot of refinances, right? So you have a lot of folks that have existing mortgages that refinance their home, take advantage of that 3% rate. Now, once the rate starts to climb up, those folks that refinanced are thinking, well, do I really want to give up my 3% rate and then go buy a new home or a pre-existing home and reset my mortgage at, close to 7%? Probably not, right? So that alone is one of the reasons why the number of homes sold dropped so dramatically. The second reason why the pricing dropped, the number of homes sold dropped so dramatically is because buyers were in a similar situation, only in the reverse direction. To them, they were thinking, well, the homes I could afford at 3% interest rate, I can no longer afford at 7%. And for that reason, they tend to stay put. And again, it brings down the number of homes sold. So you had these two factors working, with or against each other to basically bring down the number of homes sold from 9,000 all the way down to about 5,000 in a very short period of time. Now, when we look at home pricing trends, I put together two charts here that, again, look at the data over a 10-year period of time, right? From 2015 all the way up to 2024 year to date. And in these two graphs, I overlay some different pieces of information. On the left, I've plotted the average sales price of homes and overlaid the average sales price to list price ratio, okay? And on the right, I took the average sales price per square foot and overlaid on top of that the average days on market it took homes to go from active to pending. And what we see is that the average sales price rose over the last year by about 9.5%. And so we're sitting currently at about $550 per square foot. If we look at the average time it took from a home to go from active to pending in 2024, that's been sitting at about 22 days. And during the COVID boom, these numbers are quite staggering. During the COVID boom, which is basically between 2020 and 2021, homes were selling at a 3.5% premium above their list price, okay? And the average sales price rose from 2020 to 2021 by 25%. That number is just mind-blowing when I think about that. And homes were taking only 15 days to go pending. Now, the 15 days to go pending, if you peel the onion on that a little bit, that basically means that homes were getting offers within a few days of them hitting the market, right? So you get offers, and it takes, a week, 10 days to negotiate an offer, get all the price and terms dialed in for a contract to finally, get ratified and go pending. So the fact that it was just taking 15 days for homes to go pending basically meant that you're getting offers within 2 or 3 days of a home even just hitting the market, which is incredible. Now, if you look at historically, the annualized price growth over the last 9 years has been about 8.5% per year. And then if you zoom out even further and look at like the last 25 years, for example, you'll see that we were sitting at about a 5.5% year-over-year growth over 25 years. So 8.5% super high, certainly 25% from 20 to 21 is just insane. So the question now becomes is can this continue? For how long will this continue, et cetera? Okay. We now shift and look at inventory of homes for sale. Now, this is the other side of the coin that I think is fairly interesting. I show a few different charts here on the bottom. On the very left, I'm basically showing between October of 23 and October of 24, the number of active single-family residences that were on the market. Okay. In the middle there, I'm showing the supply of single-family homes, the change in that supply between October of last year and October of this year. And then on the right, I'm showing data between 1982 and 2022, which really shows, where San Diego was sitting from a supply versus deficit standpoint, to kind of gauge what supply has been doing. And overall, when you look at all these charts, what you'll find is that inventory levels are up, as we looked at earlier, about 31% for single family residences. So again, we're at about a 2.3 month supply, which is a 28% growth year over year from 1.8 months of supply to 2.3 months of supply. Now, although I did allude to the fact that that's great news, right? We have inventory levels coming up. The bad news is that really squarely still puts us in a seller's market. And why do I say that? I say that because typically a balanced market requires about 5 to 6 months of supply. So you can see that, at just 2.3 months of supply, we're still, quite entrenched in what we call a seller's market. And then, of course, based on that chart on the far right, San Diego is still very supply limited. New home builders are seemingly still quite gun shy from the Great Recession back in 2008. Because if you look at this, deficit trend right here, this local peak right here is about at 2008. So from 2008 to 2022, we've basically been running at this massive deficit. Again, just an indication of new home construction builders being a bit gun shy after what happened with the Great Recession. Okay, no, I don't think any real estate talk would be complete without taking a look at the rent versus buy analysis. Okay, so here, what I'm looking at is a sample home. This particular property happens to be a two-bed, two-bath condo in La Jolla in UTC, which is about a mile and a half away from UCSD. And what I tried to do here is I used a rent versus buy calculator. This particular one is from calculator.net. And there's a ton of them out there. You can use any number of them, but I kind of like this one. And what you can do is you can literally enter in a bunch of parameters here on the right. And based on what you enter, then you can kind of plot, or the tool will plot on your behalf, what the buy versus rent equation looks like, right? In this particular case, based on the information I entered in on the right, which we'll look at, it's basically cheaper to buy as long as you stay put for about 3.3 years, right? That's when the two lines intersect. Obviously, when you buy a home, there's an initial outlay of cash in the form of a down payment, and which is why the blue line is higher initially. But over time, those lines cross, and it ultimately ends up being cheaper to buy under these assumptions that I entered in on the right. So what are some of those parameters that I entered in on the right? So for example, you can put in things like, obviously the purchase price, your down payment, your interest rate, but then you can put in all of your expenses associated with owning the property taxes, property insurance, etc. And then you can estimate, well, what would the home appreciation be on this property? And, I use 3%. That's super conservative based on the data that we looked at over 25 years. We just saw it was 5.5%. But again, just to be conservative, I put 3%. And then you can put some disposition costs to when you were to sell the property, what that would cost you, et cetera. And the tool takes all that into account. And what it basically ends up doing is taking your equity that you gain over time from your principal pay down and from the appreciation, and then offsetting your monthly outlay of cash to figure out, over time how these two curves would intersect with each other, if that makes sense. And then of course, here on the far right, you enter in, your monthly rental rate, how fast you think that rental rates will grow over time. And then the other key piece here that you have to put into this calculator is your opportunity cost of capital. Because as you know, if you take your down payment and you buy a property, that means that you're not able to use those funds for anything else to put into an investment into the stock market or wherever. So that's why the tool asks you for your investment return rate. I threw in a number here of 7%. So again, if you look at the chart, about 3.3 years. Now, other than the math, there's a ton of subjective factors that go into a rent versus buy analysis. I won't go into them all, but I mean, obviously, if you need to be mobile for a period of time, if you've had a bad experience dealing with the landlord, whatever the case might be, there's a ton of non-financial reasons why someone might choose one over the other. But this calculator is pretty nice to help you figure out the financial piece anyway. What I did on the next chart, I thought this would be kind of fun to see, is what happens when we enter in an opportunity cost of capital of 15%. So I basically included an average return, investment return of 15% annually, just to see what that would do. And of course, at that opportunity cost, the two curves are basically on top of each other, and renting is basically cheaper to buy than buying over the next 30 years. So if anyone knows any, investment opportunities that are yielding 15% a year for the next 25 years, definitely reach out to me. I'd love to hear more about that. Okay, so let's take a look at the 2025 outlook. All right, so one of the biggest challenges that we've seen in 24, which I think will continue into 25, at least for the first quarter or so, is this so-called lock-in effect that I described between buyers and sellers, where sellers are hanging on to their low mortgage rates, buyers are kind of gun shy about the high interest rate. So that will likely continue into the Q1 of 2025. Interest rates, by all accounts, as inflation starts to cool, interest rates are likely to come down in 2025 from about 6.6% down to about 5.9%. And so these lower rates may loosen the lock-in effect that we've been seeing, and increasing inventory of homes that become available for sale. Of course, when we have this increased demand from the lower rates, that will tend to have upward pressure on pricing, and albeit at slower rates. So I don't know that we're going to be seeing 9.6% rates, for the foreseeable future, but we should still see growth rates in about the 4 to 5% from what we can tell. And then if you look at the net shortage of home supply from the previous charts that we looked at, the net shortage will continue to be a backstop for house pricing in San Diego in the future. Okay, now I want to shift gears a little bit. Let me just do a quick time check. Perfect. Okay, so now what I want to do here on the second half of the presentation is dive into the NAR litigation, and then the subsequent settlements, and then what that all means for the industry going forward. On this particular slide, what I wanted to do is just kind of walk through the timeline a little bit so you can kind of get an idea of what happened when. So things kicked off in March of 2019, right? A class action lawsuit was filed against the National Association of Realtors on behalf of home sellers. And these lawsuits basically alleged that NAR's compensation rules did a couple of things. First off, the claim was that they lacked transparency and that they violated antitrust laws by inflating commission prices and thereby reducing competition. Um, Several years later, in October of 2023, a federal jury found NAR liable and awarded them 1.8 or awarded them to pay 1.8 billion in damages. That's billion with the B, which is mind blowing. And then, of course, on March of 2024, a settlement was reached where NAR agreed to pay $418 million in damages. And the key thing here is the second piece of this is they agreed to make sweeping changes to industry practices. And that's really what we'll be taking a look at in the next few slides. Now, these industry changes took effect earlier this year in August 17th of 24. Now, before we can really, jump in and take a look to see how the changes are going to affect the industry, I thought it was useful to kind of dive in a little bit as to understand what the seller grievances were from the lawsuits to begin with. And to figure that out, or at least to understand that, it requires some understanding of the historical commission practices that have taken place over decades. Okay. So bear with me a little bit, but we're kind of just going to go step by step. So listing agreements historically included two things. Historically, they included a negotiable listing commission. It could either have been a percentage or a flat fee, and that listing commission was paid for by the seller to their listing agent for services rendered. Okay, so they hire their agent, they agree to pay him, in my example, 4% or $30,000, doesn't really matter. It was always negotiable. And they paid him that amount to sell their home. Simple, right? The second piece of this, though, was that a listing agreement also historically included a negotiable percentage of that listing commission. In my example, I use 50%, but again, it could be anything. And it was 50% of that 4% or 50% of that $30,000. So if a seller paid their listing agent 4%, the contract would say, hey, I'm going to take 50% of that and I'm going to offer that as a payment to a buyer's agent for them to bring a ready, willing, and able buyer to the table to purchase this home. Okay. So the advantage of a structure like this, and again, this structure had been the case for, decades. The advantage of this structure is that you've got two independent agents, which means two independent fiduciaries. So you got the listing agent's fiduciary to the seller, a buyer's fiduciary to their buyer, and this was all happening at no cost to the buyer. Okay. Because again, the seller paid their agent, the listing agent paid a split of that to the buyer's agent. All right. So no cost to the buyer all this time. Now, what were the seller grievances in this lawsuit? There were a few things. Okay. The first thing was that sellers felt that they were being told that they had no option other than to pay 6% to get their home sold. Now, while I don't believe, I don't not, I absolutely do believe, I absolutely do believe that there were some sellers that in fact did believe that. The fact of the matter is, though, it was in bold in every contract that we signed, right? This is in all 50 states, by the way. It's in bold at the top of every listing agreement, and it clearly stated that, hey, look, these commissions are negotiable. They're not prescribed by law, and yeah, they're fully negotiable. But nevertheless, some sellers believed that the 6% was required and that they were being forced into that structure. Okay. The second grievance that sellers had was the lack of transparency about sharing of the commissions. So in some cases, sellers were not aware that their listing agent was then offering a commission share to the buyer's agent. Okay. Now, while they may not have been aware of that, I mean, it was in the contract that they signed, but even if they were not aware of it, at the end of the day, it shouldn't have really made a difference one way or the other, because a seller is hiring their agent, they're paying them, in my example, 4%, and that listing agent is using that 4%, at least some of it, to market the property, maybe do some staging, offer a split to the opposing broker to bring their buyer, etc. Right? So how those monies were divvied up is really of no consequence as long as a listing agent was ultimately able to deliver on their commitment. And their commitment was to sell their seller's property at a price and terms that was acceptable by the seller, right? But nevertheless, buyers felt that there was a lack of transparency here with this. Lastly, sellers felt that they were forced into commission sharing with buyer's agents. And so you had this situation where they were forced to, share. They felt that they were forced to share their commissions. And so this is really not a great thing because actually, you know what I'm going to do real quick is give me 1 second here. I'm going to see if I can move this. Okay. Sorry about that. Okay. So what happened here was sellers just felt like they were being forced into commission sharing, and they didn't want to do that. And they felt like, hey, look, if you're going to offer a commission to a buyer's agent, then that buyer's agent is just going to come around and come back to me and negotiate against me. Okay. And that was really what their grievance was all about. Certainly, that's one way to look at it. I would offer a different way to look at it. You're not really offering a commission to a buyer's agent to come back and negotiate against you. Really, what you're doing is you're offering a commission to a buyer's agent so that they can bring a ready, willing, and able buyer to the table. Because at the end of the day, without a buyer, your home is not going to get sold, right? That's just the reality. And so, again, while you could certainly look at it this way, that's really not the intent. The intent is to bring a ready, willing, and able buyer to purchase your home. All right, so now that we understand a little bit about the seller grievances, let's take a look at what this ended up looking like from an industry practice change point of view. All right, now if we look at the industry practice changes, they really affected both the buyers and the sellers. What I tried to do here was, split the two up. So we're going to talk about the buyer impact first. Definitely, the practice changes are having a larger effect on the buyers. There's no question about that. There is some impact to sellers, of course, but by and large, the impact is definitely more so on the buyer side. Okay, so what are the changes? Buyers' representation agreements are now required between a buyer and their agent. Okay, previously, this was really something that was optional. And that's no longer the case. If you want to hire an agent, you're going to have a formal representation agreement in writing. What this buyer's representation agreement has to include is a commission owed by the buyer to their agent. Now, think about that for a second. We just said on the previous slide that the way this commission structure was over decades is a seller would pay their listing agent, and the listing agent would share some of that commission to a buyer's agent. So a buyer got representation effectively for free, and you had two different fiduciaries in that transaction. Okay. So buyer didn't have to worry about this before. Now, guess what? Now buyers are actually going to have to sign an agreement if they want representation, and they're going to have to commit to basically paying their own buyer's agent. That's in addition to paying their down payment, in addition to paying their closing costs. Now they're also going to have to come up with cash to pay for their buyer's agent. And that's a significant change to how things will transact and move forward in this new age of real estate. The third bullet just says that the agent compensation may not exceed the amount that's specified in the agreement. Okay, pretty straightforward. Once you agree to an amount, you can't go above that. And prior to showing a home to a buyer, the buyer's representation agreement has to be established and fully executed. So no longer can an agent just say, hey, look, sure, let me go and open up this house for you. It's on lockbox. We can go take a quick look at it. Well, not so fast. Now we have to make sure that there's a formal representation agreement in place in writing before we can allow our buyers access to view homes. And then the last bullet just basically says they put a max duration on these representation agreements of 3 months. Of course, they can be renewed, but they do terminate automatically and expire at 3 months. Oops. Okay. Industry practice changes for sellers. Listing agreements now will include the commissions owed by the seller for the seller's side only. So if you recall, previously, the seller would include the total amount of commissions in their listing agreement, and then there would be the commission share between the two brokers. Now, a seller is just going to include a seller and their listing agent is just going to include in their listing agreement one side of the commissions, right? So basically, what this is saying is, hey, Mr. and Mrs. Seller, you're gonna pay for your agent, and Mr. and Mrs. Buyer, you're gonna pay for your agent, and they're gonna be left separate, just as I described. Okay. The listing agents are now going to be prohibited from the entire commission share structure that was in place for decades. And the way that sharing typically took place was via the MLS. All right. So they're going to be prohibited from offering that commission share via the MLS as of August the 17th of this year. Again, listing agent commissions may not exceed the amount specified in the agreement. And the last bullet is sort of a key point here. Sellers are permitted, at their discretion, of course, they're not forced to, but at their discretion, they're permitted to pay for or at least offset a buyer's financial obligation to pay their agent. Okay, so now we know that a buyer they have to now pay their own agent, right? That's the new rule. But what we're also saying with bullet number 4 is that a seller can say, hey, look, I'll go ahead and offer a buyer concession to help you, Mr. and Mrs. Buyer, pay for your agent. And we'll talk a little bit about why they may want to do that. But this is definitely something that is permitted. So it's not the listing agent that's paying for the buyer's agent. It's the seller themselves that's going to be potentially paying for a buyer's agent. All right. That's one of the key components of the industry changes going forward. Okay, so now if we break this down and say, hey, look, what are some buyer takeaways in all this? What does this really all mean as far as representation is concerned? If a buyer wants to be represented in a transaction, they've got a few different options. They can certainly choose to not be represented at all. There's no law that says that you have to be represented. I could go and say, hey, look, I'm just going to go in and purchase it on my own, unrepresented. Personally, this isn't something that I recommend. There's just too many ways for a buyer to be taken advantage of by experienced listing agents that definitely know real estate law, and they definitely know, the industry standard practices of what's typical and what's not typical in the transaction. And a buyer that's representing themselves for the first time are certainly not going to know that. And there's a lot of opportunities to be taken advantage of. So for this reason, I don't recommend the first bullet at all. The second thing a buyer could potentially do is they could approach the listing agent and say, hey, look, why don't you just represent me and the seller on this transaction, right? So that's dual representation is a thing even before the changes that took place in August of this year. So in dual representation, a listing agent is going to get paid by the seller. They're also now going to get paid by the buyer. But now the listing agent has a fiduciary obligation to both the buyer and the seller. Okay, so we don't think this makes a lot of sense. We didn't think it made sense before, and we certainly don't think it makes sense now. And the reason why is because this creates an obvious conflict of interest, and in my opinion, is analogous to a plaintiff and a defendant being represented by the same attorney in the same trial. Okay, so this just doesn't really make any sense to me. The third bullet is brand new with the new structure. A buyer now has the option of approaching a listing agent and saying, hey, look, would you be able to write this offer for me? I'm interested in this house. Can you go ahead and write this offer for me? And a listing agent could potentially do that with no implied representation. Now, in my view, this is even worse than dual representation. At least with dual representation, okay, you had a fiduciary responsibility to both parties. As you know, an agent would say, okay, I have a fiduciary to my buyer and my seller. So the buyer is at least getting some representation, the seller is at least getting some representation, both of which is poor representation because of the conflict of interest, but representation nonetheless. In this third bullet, what we're saying is a buyer could ask a listing agent to write the offer for them, and it's very possible that a buyer, when they do that, and they sign the form and they have the listing agent there that they're talking to and preparing the form, they could be under the impression that they're getting they're getting representation. They could be under the impression that they're acting in a fiduciary responsibility. And that's very dangerous, in my opinion, because now the listing agent can basically be advising this buyer in a non-fiduciary capacity. And they're fiduciaries to the seller, and the buyer thinks, in fact, that they're being properly represented. So for me, this is even worse than dual representation. The last bullet, in my view, is really the only option for buyers, and that is you hire a buyer's agent to exclusively represent you, and then in your offer, you simply ask the seller to pay for the buyer's agent, your buyer's agent, as a term in a purchase contract. So we just looked at the previous slide. That provision is allowed. Sellers are able to offset your financial obligation to your buyer's agent. So why not just throw that in the offer? Put that in the offer, try to minimize your impact to have to pay your own agent out of your own pocket and get the proper representation that I think you need. Okay. So these are the key buyer takeaways. As far as seller takeaways, what to expect when selling your home. Sellers should definitely be aware of a new provision in the residential listing agreement, which allows listing agents to charge sellers an additional commission if a buyer comes to them unrepresented. Okay. We just saw in the last slide, bullet number 3 was that new term. A buyer can go to a listing agent and say, hey, look, can you write this offer for me? A listing agent is allowed to do that, but the listing agent can then tell the seller, hey, look, because of this increased workload that I have to do, I have to write this offer now for the buyer. I'm going to have to charge more for this transaction. So Mr. Seller, Mrs. Seller, you're going to have to pay me an extra however much amount so that I can write this offer for this unrepresented buyer. So now the listing agent makes more, the seller has to pay more, and the buyer still doesn't get any representation. So this is definitely something for sellers to be aware of. In my view, sellers should refuse signing a term like this under all costs, okay? Under no circumstance should a seller agree to this term. And if they can't make that happen with their listing agent, they should really go find a listing agent that won't make them subscribe to this term. And in my team, I've basically banned this term from my team. And anyone on my team that uses this term will be terminated pretty quickly. So for me, this is a non-starter. Okay, now if you look at the second bullet here, sellers should absolutely be open to offering a buyer's agent's commission as far as a concession to pay for a buyer's agent. Why would they do this? It maximizes your buyer pool. What do I mean by that? Well, if you have a group of buyers, okay, you have a group of buyers, some of them will say, hey, look, okay, I need my down payment. I now need to pay for my buyer's agent. I need to pay for closing costs. Okay, I'm all set. I've got all that ready to go. I'll go ahead and do all that. But there's going to be another group of buyers that are basically going to say, well, I don't really have any free cash to go and pay for a buyer's agent. I just have enough for my down payment and my closing costs. And so if sellers were to offer this concession to buyers, then it'll increase the total buyer pool to include both groups, and you'll basically increase your chances of getting multiple offers on your home, which will increase your chances of selling your house above your list price. So in my opinion, sellers should absolutely be open to a buyer's agent fee concession. And then lastly, sellers should basically evaluate offers based on price and terms. So you're going to look at it based on the normal stuff like offer price, closing cost allocations, repair credits, interest rate buy downs. But the new thing that you'll be evaluating the offer as a seller is you'll be evaluating it based on what a buyer has asked you for as in the way of buyer's agent fee concessions. Just another term, right? There's tens of terms in these purchase contracts, and the buyer's agent fee concession will simply just be another term to factor in as a seller calculates how much cash they'll have in their pocket once they ultimately sell their home. Okay, hopefully that all makes sense. And that takes us to the end of the presentation. What I did here was I just included the best ways to get a hold of me, my website, phone, email, Instagram, Facebook. Feel free to reach out with any questions that you have. And I think we can open up the floor to some Q&A now.
All right. Well, thank you so much for this very informative Mud Talks. We do have a few questions. So on one of your slides, you had an estimate of like maintenance cost of buying a home, and it seemed kind of low. Was that assuming that was a brand new house?
It was not assuming a brand new house. I looked at that and actually it's an interesting question. The default on that calculator was higher, actually. Um, but I looked at homes that I've, owned, my clients have owned. Um, and if you kind of look at it, it was pretty high as far as what they had initially underwritten for. So I just put a number in there that I thought was, reasonably consistent with my experience.
Great, thank you. Our next question, do you think the new arrangements will lead to more direct sales between owners and buyers without agents?
Um, it's possible, but it's that wouldn't really be recommended. I'll tell you why. It's funny actually because when I purchase homes for myself, I'm representing myself, and it's interesting because when I'm dealing with the other party, in this case, let's say the listing agent, it's very difficult to separate, my emotions from, what needs to happen in the transaction, being that I'm representing myself and I'm the buyer at the same time, right? And that's with the training, that's with the licensure that I have gone through. So if you put a buyer and a seller and just have them go and sort it, I think that could go south pretty quickly. It's just my opinion.
Thank you. How much variability can there possibly be across different neighborhoods in San Diego?
Yeah. Yeah, there could be quite a bit of variability actually. I mean, if you look at things like closer to the water, like La Jolla, Del Mar, price per square feet will definitely be higher. As you go further and further inland, that price per square foot will be a bit lower. The one nice thing about San Diego, and it's a little bit different, than what I've seen up in LA growing up there. San Diego has some really, really good school districts in various different price points. So it offers really a lot of, a selection for families that are interested in school districts at various different price tiers.
Great, thank you. Our next question, given recent sales and building trends, is there a type of home, apartments versus condos versus SFH, that would be best to target as an investment or a rental home?
Yeah, it's a good question. So, they both have, well, okay, let me put it this way. Single family homes and condos have different pros and cons, right? So condos, you're going to have an HOA fee and you're going to have to pay that and hope that the HOA is going to use those monies wisely to maintain the property. On a single family home, you basically are the HOA at the end of the day. And what we typically see is on the single family home side is the annual growth rates tend to be higher than, let's say, on the condo side. Um, Having said that, we have a little bit of both. I mean, we have a single family home as a rental. We just purchased a condo in La Jolla. In fact, the example I used earlier in my presentation, that was of a condo that we just purchased over the summer. And it's been great so far. We purchased at about a 5% cap rate on that one. So you can make an argument for either one. It just kind of depends on the numbers at the end of the day.
Great, thank you. Let's see. Is the SALT tax deduction cap in, sorry, a lot of acronyms, impacting San Diego housing market today? And if cap goes up or wishful thinking goes away in coming year, how will that impact San Diego housing market?
Yeah, that's a great question. We haven't seen a lot of impact on that yet. Um, we could though. I think the jury's still out on what that's going to do.
Great. Can a seller's concession to pay part or all of the buyer's agent fee be specified in the MLS listing, or is it communicated to the buyer?
Uh, it can absolutely not be communicated in the MLS, for sure. But what we can do is, let's say a buyer's agent could call the listing agent and say, "Hey, look, is your seller open to concessions, some buyer concessions, buyer agent concessions?" And the listing agent would either say, "Nope, they absolutely are not," or they can say, "Yeah, they're open to it. It's going to be, 2%, or it's going to be 2.5%." Or they can answer, and what I'm seeing most frequently is they can answer it this way. They can say, yes, they are open to concessions, but it's going to be subject to the terms of the purchase offer. In
Got
other
it.
words, right? In other words, if an offer is, if it's a low ball offer, they're going to be less likely or less inclined to offer a buyer concession versus if it was a strong offer.
Got it. Thank you. You recommended buyers to ask sellers for a buyer's agent fee concession. If the seller refuses, is the buyer left with no choice but to pay their agent or look for another property whose seller is willing to offset their agent costs?
Exactly. Exactly. Those are your options. If they refuse to offer a buyer concession, then yeah, then a buyer would be on the hook to pay for their agent out of pocket or look for a property where those concessions would be applicable.
Thank you. Um, do you have any advice for first-time buyers for all our alums who are looking to purchase a home?
Yes, get a good buyer's agent. No, I'm kidding. No, actually, it's funny because I've had a number of first-time buyers just, randomly, over the summer. And I really like first-time buyers. And the reason why is because they're always very, very appreciable. They're really new to the process. And, they take what you say in stride and really kind of pay attention to the details. So the advice I would say is you do really want to have a buyer's agent that's going to take the time and not treat you as though you've done a bunch of purchases in the past, right? You're going to want someone that really walks you through things step by step. In the example I'll give you, with my first time buyers over the summer, I literally walked him through paragraph by paragraph of the purchase contract. That contract's about 23 pages long. And we literally, in small font, we literally walked through paragraph by paragraph, and I explained what each section meant. It took about an hour and 15 minutes to get through it all. But I prefer that versus just saying, hey, don't worry about it. It's just a bunch of boilerplate stuff. Here's the offer price, here's your down payment, just go ahead and sign the bottom. In my opinion, that's not really the right way to proceed.
Great, thank you. And then coming up on the hour, so any last advice or recommendations that you recommend for those who are looking to purchase at this time and point?
Yeah, yeah. I mean, I would keep tabs on inventory levels. I mean, definitely I think we're gonna see inventory levels start to come up a bit, which is going to be great, right? As interest rates come down a little bit, that's gonna free up that lock-in effect. And so sellers at say at 5.9% interest rates, sellers will start to say, hey, look, maybe I can now find something else that I would like. As they do so, inventory levels should start to come up. And it should give buyers, that are looking a reasonable selection of homes to choose from. So I would say, actively monitor inventory levels and interest rates going forward.
Great. Thank you so much. Well, I want to thank you for joining us today and for sharing your knowledge and insights with us. Thank you to our audience for your questions and for attending this event. We'll follow up within the next week or so with a recorded video. If you are interested in being a Mud Talk speaker, please contact us at alumni@hmc.edu. Stay tuned for more Mud Talks in 2025. All future events can be found on our website, alumni.hmc.edu. Have a great night, everyone, and we'll see you next time.
Bye-bye. Thanks for having me. Bye-bye.